Common Sense on Mutual Funds by John C. Bogle, The Index Fund Advantage. Welcome to yourbooksummary.com. Index funds are an excellent foundation for your investment portfolio. Over the long term, active managers don't outperform the market, and it's impossible to predict the few exceptions who do. The first index fund was an S&P 500 fund because the S&P 500 is a well-structured index representing about 90% of the stock market capitalization. Although it still represents a significant portion of the market's capitalization, the S&P 500 now only represents 3/4. You can purchase the Wilshire 5000 Equity Index to own the entire market. However, the S&P 500 and the Wilshire 5000 generate similar returns in the long run despite short-term differences. Indexing works well in any market and offers cost advantages that make it a better choice than other options, even in relatively inefficient markets. Index bond funds work as well as index equity funds. Paying an active manager to select homogeneous assets such as bonds doesn't make sense. Investing in index bond funds allows you to diversify broadly and reduce risk without sacrificing returns. Most index bond funds enable you to target the bond's maturities and buy and sell small amounts of shares. However, these funds often charge more than these advantages are worth. Cost is even more critical in bond investing than in stocks. Paying a load fee for a bond fund or a high expense ratio makes no sense. I hope you found the information about Common Sense on Mutual Funds by John C. Bogle. If you're interested in learning more about the book, stay tuned for the next part of this series where we'll dive into the next section. Thanks again for watching, and I will see you in the next video.